Thank you, Skip. You know, it occurred to me that Skip has done amazing things here at the Clinton School. And one thing is that I think that he's turned the Clinton School into the town square of Little Rock. It's Speaker's Corner, and it's amazing that he has been able to achieve that, and he's obviously running out of well-known and good speakers. So today is purely evidence of that. Governor Tucker, it's great to see you here today. On Friday, October 3rd, President Bush signed into law the Economic Emergency Stabilization Act, the so-called financial rescue package. So what now? You know, we're in a difficult economic time, and my stage setter for thinking about this issue is to remind you that this is not the first time that we've had economic trouble in our country, nor will it be the last. And that while this gets all the attention of the cable news shows, that in times past, it's been just as intense. I've got here, and I think political cartoons are the best way to illustrate that. Here's the panic of 1837, and the poor chap there in the center with the green coat has lost his job, and on that newspaper in his hand it says, "New Error." And his family are saying, "We're hungry." And the two guys with the top hats and blue coats, everybody knows what they are, bankers. They're saying your rent is past due. Let's go to the next one. 1857, this was a popular play at the time, The Run on the Bank. Let's go to the next one. 1873, that's in New York, The Run on the Fourth National Bank. 1893, the bottom is out of the hot air balloon there, and it says gold speculation on the balloon. Everything coming down. Panic of 1907, just 100 years ago. Those are all the speculators being thrown into hell. And last but not least, we've got President Hoover, who's saying, take a detour business away from Speculation Street and go down Business Boulevard. So, you know, what goes around comes around. So I think that's a good way to open up our visit today. To depend on the government to bail out every taxpayer who bought too much house is a dumb idea. But likewise, to offer total disdain for the government performing a role to stop a systemic crisis and improve liquidity, create an effective monetary policy, and enhance financial regulation is equally misguided. With that, no piece of legislation signed by President Bush on October 3rd or any other date, or no action by the Federal Reserve Board of Governors is going to cure what ails us. This global crisis has been years in the making, and it will be years in the healing. These periods of turmoil and upheaval are ultimately constructive for the economy and its participants. And we learn that ancient adage one more time, all success is fleeting. During an economic downturn, competition, new technologies, all those things are competitive and part of what the Austrian economist Joseph Schumpeter termed creative destruction. They're essential for the innovation and rebirth of capitalism. And downturns are a reflective period and one of significant revaluation by all participants in a market economy. But over time, the animal spirits, as described by John Maynard Keynes, come back to life and growth begins. The recent legislative and administrative steps will slow the bleeding, get the patient to the hospital, but in my view, surgery is still needed. The panic of 1907 that I referenced in the cartoon led to the creation of our independent central bank, the Federal Reserve System, in 1913. But not since the dark days of 1929, when President Hoover was struggling with what to do about the stock market crash, have we suffered so badly and had the potential of such a significant systemic collapse. Since those days, we've learned a lot about prudential regulation, the role of low tax burdens, the importance of free trade, and the importance of a robust monetary policy and the need to act promptly. Because all those things were early errors in the Hoover administration. He raised taxes. He curtailed free trade. We had no active, aggressive monetary policy. And all those things exacerbated the systemic crisis and made it worse at that time than possibly it might have been. All the tests that we've had since the Great Depression, in my view, have been relatively isolated tests. And this is a key point on maybe why we are reacting so disjointedly, some might see at this time. We had isolated corporate failures like Chrysler in the 1970s, long-term capital management in 1998, Drexel Burnham Lambert in 1990. Or we had a very narrow and easily understood and dealt with geographic or industry type crisis. New York City, Orange County, Mexico, or even our savings and loan bailout. Nothing was a global systemic challenge. It was a very narrow, relatively easily understood challenge, and it was quickly dealt with. Today's crisis is global, it's complex, and it affects institutions of all sizes and missions. More alarmingly, today's problems and challenges to capitalism come from immense self-inflicted wounds, led by a lack of prudential risk management, and where we are trusting computer models and more than our own common sense. In other words, as my cousin in New York says, beware of geeks bearing gifts. In public policy, errors have been made in monetary policy and in regulatory policy. Perhaps the great political sage Pogo said it best, we've met the enemy and he is us. For the better part of 30 years in public and private life and finance, I've seen the potential for this train wreck coming, and that's why I felt compelled to offer comment on it today. Now, with the benefit of hindsight, we can see the ignition points that led to what we saw in August and September of this year. Individual investors, after the tech crash in 2000, turned to real estate as their safe alternative investment. The Federal Reserve, in response to 9/11 and to the recession that began at the end of the Clinton administration, continued to lower rates, and in my view, monetary policy remained too accommodative for too long. These events began a nationwide increase in real estate investing. As these macroeconomic events were unfolding, market forces reacted to two other congressional changes that were taking place at the same time. First, increasing mandates and increasing pressure on Fannie Mae and Freddie Mac, our two big government-sponsored enterprises engaged in secondary home mortgage lending, for increased levels of home ownership at the lower bottom of the economic ladder, setting specific numeric goals. And secondly, congressional direction prohibiting regulatory oversight of derivatives, particularly credit default swaps. As a result, today's crisis is at its heart an out-of-control derivatives frenzy centered on increased real estate investment and by low rates and perverse congressional incentives. Derivatives can be straightforward and easy to understand. Somebody can be long or short a one-year contract on natural gas. That's a straightforward futures derivative. Farmers use derivatives every day to hedge their crop of corn or wheat. But many have been designed to have many variables extended over an extremely long contract period, not just 1 year, say 20 years. Enron had a contract for the future price of newsprint for 100 years. unless a contract is secured somehow with collateral or a guarantee, then the terminal value depends on the creditworthiness of the two parties in the transaction. This, of course, is a key problem. As the counterparty's credit is downgraded, receiving a lower rating by one of the credit rating agencies, then they have to put up more collateral, straining liquidity. As I said, Enron was famous for its esoteric derivative trading, and you all know the end of that movie. Warren Buffett and Charlie Munger, chairman and vice chairman respectively of Berkshire Hathaway, have been warning the market and investors about derivatives, or as Warren likes to call them, financial weapons of mass destruction, since 2002. Buffett has described derivatives as like hell. They're easy to get into, but impossible to exit. Congress and the Treasury have effectively agreed to acquire illiquid, complex derivative instruments from banks, insurance companies, and brokerage firm balance sheets. These acquisitions will be accomplished at some basis of market value. Therein lies the rub. What is market value? Here are my favorite accountants. The accountant turns to his boss and says, "We're projecting a profit, but not within our lifetimes." Many are arguing for the elimination of accounting rule FAS 157, which is mark-to-market accounting. If you watch cable news, you'll see talking heads rattle on about mark-to-market accounting and how that's caused this crisis. Generally, I think changing FASB 157 for mark-to-market accounting is a bad idea. Buffett calls tinkering with these basic accounting rules as mark-to-myth. Buffett himself has firsthand knowledge of these struggles when Berkshire Hathaway bought General Reinsurance Company in 2002. They spent years trying to unravel their portfolio, and after about 10 months, in the first 10 months of that acquisition, they still had 14,352 contracts remaining with 672 counterparties scattered around the world, and Berkshire Hathaway lost millions. In my view, today's holders of collateralized debt obligations or collateralized mortgage obligations, for the most part, have written down much of their loss. And because no one has any idea what a collateralized debt obligation is or a collateralized mortgage obligation is, my handy assistants and I have gone to Google and produced a chart. And the chart, Dr. Holland, is from Lehman Brothers' website. So we know it's accurate. So the bottom line is that someone creates an entity, a legal entity, a special purpose vehicle, and they get a bank to be the trustee of it and to make payments so that when the home mortgage person makes their mortgage payment to that trustee, the trustee then makes bond payments out to the people who buy the investment. So people come along and they buy the investment and they put money in the SPV, and the SPV then gets mortgage loans from people, and that's how one is set up. And they leverage it, though. You say, well, this just sounds like a normal sort of business transaction. And it is normal, but the problem is where they leverage it. And so these investments are not in and of themselves unusual to take a pool of mortgages and then put them and sell interest in them to somebody else. But I made a hypothetical example. If you had $100 million, and I made it simple, 1,000 houses worth $100,000, and everybody paid a 7% mortgage rate, and they expect 2% of those loans to go bad at any one time. But then the default rate, the people who can't make their mortgage payment, goes to 12%. So, wow, it's a big jump. So 120 of those 1,000 houses now are in foreclosure. And I said for fun purposes that they only went down by 20%. Well, The other 880 houses are paying their mortgage on time. But the yield on that $100 million is now dropped to 6%, let's say, to make the numbers round. But the investor, Dr. Holland's investor, still wants to earn 7%. That's what the deal was. You told me 7. So that $100 million is now valued, in simple math at, what did I say, 87 million. But times are tough. People are scared. These markets may not perform right. So someone says, I want a 1% premium. I want an 8% yield off that portfolio. And so the $100 million drops to 76 million. And that's what's going on out there in the market. And that is mark-to-market accounting, and that is what people are struggling with. And that's why if this happens on a large scale and you've borrowed all the money to invest in that $100 million, then you have no liquidity. And so again, that's why the television news person tells you we're having a liquidity challenge as opposed to a credit challenge only. But how do they decide 2% versus 12? Doesn't somebody think about that? We got a lot of smart people in this country. And I think about it like this. Think about, since we're almost close to Thanksgiving, got days down here on the bottom, think about that fresh little turkey up in Gravette, Arkansas in his pen. Every day for the last year, somebody's come in and given him water and food, and when it's hot, they turn on a fan, and he goes, I love humans. Things are going great. And then he gets to November 23rd, and everything he knew about his past isn't true anymore. And that's looking backwards. The turkey looks backwards. He sees nothing but a great future. Food, water, happiness, get fat, live to an old age. Then November 23rd comes. So that is also a real problem when it comes to relying on computers instead of common sense. The core function of the Treasury and the Federal Reserve actions taken by President Bush, Secretary Paulson, is to speed up this process of healing by boosting confidence, by buying assets, placing more capital into affected institutions, expanding deposit insurance coverage, forcing mergers of weak banks into stronger banks, and they're doing that in conjunction with their peers around the world. That's the purpose of what the administration is attempting to do. The credit default swaps I mentioned, and I showed you a diagram, have grown from $2 trillion, that's already a big number, it's hard for me to understand that number, to $60 trillion in 5 years. So remember Buffett's example, he had 14,000 contracts, 600 counterparties after 10 months. Now try to do that with 60 trillion and solve this problem. I wanted to show you what a credit default swap looks like, thanks to Damon Meyer at Delta Trust. These are the insurance companies in the United States, the principal insurance companies. And this is a page from Bloomberg, which is a financial service that broker and dealers have. And this is the spread in basis points over treasuries of a corporate debt obligation. So this one is, which one, Damon? Is that Prudential? Here's Prudential spread. So we go along, this is January, June, September, and then boom, we hit September 08, and the spread for Prudential debt jumps up from 100 basis points to 1,000 basis points yield over treasuries. The blue line is Berkshire Hathaway. It moved from, again, around 100 or 150 basis point spread to about 200. And the third one is Allstate Insurance Company, which also has stayed down in this 200 range. So that is telling you that someone thinks that there's a higher rate of default risk on Prudential Insurance Company than there is for Allstate and Berkshire Hathaway. And you don't know any more than that if you're just looking at one point in time, one spread, one snapshot. But that is what, when people say they're looking at credit default swap spreads, that's what one looks like. The largest banks and investment banks in the world were engaged in this business on a global basis, and it grew rapidly, as I said. Their failures have caused problems for the rest of the economy and for all of us because they've created a stock market panic that reduces the value of our 401k plans and our life savings. It causes the commercial paper market to now price dysfunctionally because these other corporate debts are not pricing correctly. It's cut short-term interest rates to the point where you're not getting much earnings at your bank, and if you're on a retired fixed income, that hurts. So that's how this impacts all of us in the country. And now comes the real trick, not a treat. The government is printing money in order to solve all of these challenges. Our goal in the banking industry is to get Barney Frank and his friends out of our boardrooms and back into the cloakroom as soon as possible. But given this complexity and massive impact, I think Congressman Frank and his fellow policymakers should focus on some key areas in the future. First of all, let's talk about the banking system. Once a nation has a rule of law, it must have a well-capitalized, diverse set of banks to ensure the flow of blood for any economy, and that's capital, to its highest and best use, which is typically measured by return on equity. Our nation has been blessed by national bank charters that were set during the Civil War, by the formation of the Federal Reserve System in 1913, and the reforms of our rules regarding the issuance of securities and safety and regulation of brokers in the 1930s. In the post-World War II world, we have realized unparalleled prosperity. And despite that generation of wealth creation and those earlier structural enhancements, like our central bank, our country's bankers and regulators have retreated for planning from the downside of an economy and only assume prosperity. Now that our rescue money has been assembled, we've got to focus on what to do now. Bank charters move away from too big to fail. Policymakers need to move away from the moral hazard of too big to fail. Over the past few weeks, we've actually been teetering towards increasing future moral hazard by only exacerbating the too big to fail notion. We need to recognize that commercial banks, thrifts, and credit unions are granted a charter and deposit insurance from the federal government. We need to increase minimum capital standards for banks, not lower them. We need a more vigorous application exercise in order to obtain a bank charter. Let's take Atlanta, Georgia, for example. As of June 30th, 2008, of the total U.S. banking system, 21% of U.S. banks with non-performing assets greater than 6% of total assets, so a quarter of the problem banks in the country, approximately 21%, were in Georgia. 18% of them were in Metro Atlanta, and 9% were startup banks. They were de novo institutions. While it is fundamental to preserve the entrepreneurial aspect of banking, that is, the right for people to come together, form a board of directors, raise capital, and succeed or fail based on their business plan, taxpayers nonetheless are owed a rigorous process whereby deposit insurance coverage is granted for a new charter. The mantra of the 1980s and 90s was that bigger is better. In my view, that's nonsense, and it has increased the risk profile of our economy, not decreased it. When I worked on the banking committee on Capitol Hill and at the Treasury, the catalyst for this point of view was that the European and Japanese universal banks would rule the world if we did not amend our rules and let our banks get to be just as large and have all of their universal product offerings. And naturally, it's true that as American business grew to large sizes and expanded globally, that they required larger and more sophisticated institutions. But we can do both. For the quarter ending June 2008, banks over $1 trillion in size had equity capital ratios of 4%. 4% does not leave you much room for error. The balance of the banking industry had ratios in excess of 6%. And the 90% of the banks under $1 billion, which is all the community banks in America, have ratios in excess of 8%, 2 times the level of the so-called too big to fail banks that we're supposed to put all of our faith in. Our country needs the diversity of a broad and deep banking system, and we need to move away from building institutions on which our economy is too dependent and as a result are too big to fail. Policymakers should consider easing the cap on total deposits in the United States below the current level of 10%. And they should reconsider allowing only the very largest of banks to control the very largest of our investment houses. It's not my intent to sound like a populist. I'm simply arguing that competition is improved by more well-capitalized players, not fewer. And I believe that bank holding company ownership rules should be amended to encourage additional sources of capital. Large private equity investors should be able to invest in large banks, just as Warren Buffett's investments recently in GE and Goldman Sachs offer new ideas, new capital, and a new sense of ownership in those companies. Some will decry my comments as heresy because they say that returns in the commercial banking industry are already too low, and that proves that we actually need bigger banks, more consolidation. It's clear now that the CEOs at Lehman Brothers, Bear Stearns, and others had no idea of the massive systemic risks their firms were taking, and my simple view is that our nation's economy is not well served by a handful of gigantic corporations that are too big to fail. Go back to that, Heidi, if you would. This Fortune article, What Were They Smoking?, has Chuck Prince, now fired CEO at Citigroup, Jimmy Kane, now fired CEO at Bear Stearns, John Mack of Morgan Stanley, and Stan Neal, now fired CEO of Merrill Lynch, all on the cover, and this is November 2007. So, you know, some of you may have noticed this last month, but we're in our 13th, 14th, 15th month of this at intensity out in the financial markets. And, you know, where were they? Where were they? The next section is to disclose off-balance sheet risk. Following the Enron debacle, corporate America got saddled with the extraordinarily bureaucratic, button-pushing, rule-following Sarbanes-Oxley Act. In addition to putting out of business one of the finest global accounting firms in the world, Arthur Andersen, for the errors of a few. But apparently we will learn nothing from the real culprit at Enron: off-balance sheet fraud and excessive derivative speculation. As I mentioned at the outset of these observations, the fundamental cause of our current predicament is a toxic pile of computer-generated, MBA-marketed derivative securities and structured finance vehicles, and to me it's the Enronization of global finance. And Congress lit the match under this derivatives explosion that led to some of Enron's problems and now to the position where we find ourselves. I mentioned this briefly at the beginning of the talk, but Congress specifically exempted credit default swaps and other kinds of derivatives from regulation in the Commodity Future Modernization Act of 2000, signed by President Clinton in December 2000. There were no hearings in Congress on that act. Congress needs to once and for all direct the Federal Reserve, the Commodities Future Trading Committee, and the SEC, Securities and Exchange Commission, to find homes for the proper disclosure and oversight of these instruments, including a clearinghouse for the proper pricing and dissemination and execution of this mountain of derivative paper. If you read your paper this morning, there was a note that an exchange, a private sector exchange, is submitting paperwork to the SEC to do that. And I think that's a good idea. Prudential rules can also be considered, such as setting a limit of capital in relation to the level of counterparty risk. Many traders are constructing derivatives with 100% leverage. Now, wouldn't you want to know the scale and scope of that if you were taking the bet on the other side, how leveraged somebody was? And from time to time, we've seen uniform standards reduce uncertainty and improve spreads and increase efficiency in markets. So I don't believe that this kind of thing is going to be beaten about the head and the shoulders as too much regulation or re-regulation or that kind of thing. We've seen that in these kinds of complex matters, uniform rules that are the roadmap are a common sense approach. However, any regulatory oversight does need to be sensitive to the structure of that oversight and not throw the baby out with the bathwater. Next section, privatize Fannie Mae and Freddie Mac. Since I was a young staffer on the Senate Banking Committee 26 years ago, Congress has added risky expansions of authority to these two government-sponsored enterprises to the point of August's collapse. Every effort to curtail their egregious lobbying expenses and their ever-increasing executive compensation have been rebuffed. Every effort to limit their scope to only helping lower-income borrowers who prudently qualify for a loan through lower-priced mortgages have been rebuffed. Even one of their own, former Fannie Mae CEO, the late A. Oakley Hunter, honestly described their daily funding requirements as the biggest crapshoot in the market. A former congressman, Hunter retired in 1981 with a modest pension of $80,000. In the 1980s, the real fun at Fannie Mae and Freddie Mac began. Imperial Chief Executive Officer David Maxwell began the march to exceptional levels of compensation and lobbying expenses. Hunter later said in an interview that executive compensation at Fannie Mae had run amok. And this was long before the outrageous and still disputed compensation packages afforded to Maxwell's successor CEOs, Franklin Raines and Jim Johnson. Key point to remember, Fannie Mae and Freddie Mac are quasi-government agencies of the federal government who would not be able to make all that money and pay anybody anything were it not for their unique government attributes that are not available to any of their private sector competitors. And yet Congress closed its eyes, as did the boards of directors of Fannie and Freddie. In their early days, dating back from 1938 during the Depression, Fannie Mae and Freddie Mac created a liquid secondary market for home loans, and they set prudential standards for common underwriting. Back to my point on credit default swaps, they actually created the common loan underwriting standards that we have throughout the banking industry today. But much of that good has been lost in the ensuing years by their poor corporate governance and by their sanctimonious lobbying, including their co-conspirators in defending their turf by the realty and mortgage banking industries. In the past 10 years alone, Fannie Mae and Freddie Mac have spent $200 million lobbying the U.S. Congress. These are government agencies. What would you say if I told you the Pentagon's lobbying expenses were, fill in the blank number? You'd be outraged. You'd be out here protesting in the streets. But they spent $200 million lobbying the Congress. There's no way, not even Sarah Palin can put lipstick on that pig. The congressional design and implemented disaster doesn't make sense, and it makes my old friend and mentor, Senator Bill Proxmire, Democrat of Wisconsin's proud attempts in the 1980s to curtail Fannie Mae's power grab for commercial lending and CEO compensation simply look quaint. The results of 30 years of inadequate oversight have exceeded even my wildest definitions of failure. $50 billion in market value wiped out in August in a week for shareholders. $15 billion in preferred stock on the books of local banks were wiped out. And a government takeover rivaling the entire GDP of all but a handful of countries in the world. So, as this crisis recedes, the Congress simply must exercise the will that it has failed to exhibit and create a safe transition of these monolithic federal orphans into private hands and insist that their charters return to helping people who need help buying a home with prudential standards. Or better yet, maybe they could be broken up into a number of institutions or go out of existence. I'm open on these topics, but they have got to be corrected. Next section, reforming securities laws and corporate governance practices. Like banks, brokerage houses need to be subject to more prudential capital requirements. Our hall of shame up there a few minutes ago, some of those companies had leverage ratios of 30 to 1. There's no margin for error. That makes a 4% capital ratio look fantastic. 30 to 1. Warren Buffett painfully learned this experience as well when he stepped in and took over Salomon Brothers as it collapsed due to Salomon's unethical government bond trading 17 years ago. He told Congress, if you're dependent on borrowed money every day, you better wake up in the morning hoping everybody's thinking well of you. And that's what happened to our brokerage firms, some of the best known names for 150 years. SEC rules governing brokers' ability to raise capital and need reform in order to tie that capital level to the risk that they're taking. Last month, the SEC Inspector General announced that only 1/3 of the 146 brokerage firms required by the SEC to report their risk assessment had done so. And of those, the commission staff had only met with 6 of them. This is in September. This requirement was put in place following the collapse of Drexel Burnham Lambert in 1990. Banks and brokers engaged in financial services have a myriad of regulators. State insurance commissioners in all 50 states, the Federal Reserve, FINRA, which is the merger of the National Association of Security Dealers with the New York Stock Exchange. They regulate brokers. The SEC itself comes in behind them and regulates brokers when they get through. The state securities commissioners in all 50 states come in behind them and see if the SEC and FINRA did a good job. Banks have the FDIC and the Office of the Comptroller of the Currency, and they have 50 state bank regulators. And you can have some multi-variant combinations of those depending on what kind of business you have. Members of Congress are currently considering a new approach to this patchwork of regulators for our financial industry. We haven't really looked at it since the Depression. Like the fresh look at our intelligence practices following September 11th, I think it's a wonderful time for the Congress to see if they can't make sense of a much more effective oversight of the financial industry. Also on cable television, you hear a lot about the short sell rule. There's nothing inherently evil about selling a stock short. It's been a practice since there were markets. It increases liquidity in markets. But the evil has been the foolish changes made by the SEC. First, in July 2007, just over a year ago, the Commission abolished the part of the rule that required that a short sale only take place on an uptick in a stock's price. That had been the rule since there was a short sale rule. So that a stock in free fall, you couldn't sell it short, putting more pressure on the price. Next, the SEC has not enforced or required proof of a short seller to demonstrate that they'd actually signed an agreement and borrowed the shares that they're selling short. That's called being naked to stock. It's always been illegal. It was illegal, again, before there was a Congress. Additionally, market regulators should consider some kind of a rule regime on selling company debt short, now made very easy with credit default swaps. You can now create a liquidity crisis for a company by selling that credit default swap. That's the equivalent of selling it short, just like you can put pressure on a company's equity. Regarding consumer disclosure, the Commission should insist on greater transparency in the work of stock and bond rating agencies, Moody's, Standard & Poor's, and Fitch, and their standards for their work. We have a little cartoon, I think, on that to wake everybody up. Maybe. I hear clicking. There it is. This says the rating process, and these two little ants are sitting there, and it says it's a indefensible organization chart. It says start, program, flow chart. Then right here in the middle, then a miracle occurs, and the end is you get a AAA rating. And this little ant says, good work, but I think we need a little bit more detail right here. So the concern was that Standard & Poor's and Moody's fell down on the job on all these collateralized mortgage obligations. They really were not providing market information that institutions or individuals could deal with. I believe they should set out a rating disclosure that's available on the internet or in the relevant prospectus or disclosure statement as to how the rating was arrived at, who the senior analyst was who did the rating, and who paid for the rating and what price. Likewise, caveat emptor, buyers of securities should demand additional plain English disclosure in order to enhance and expedite their own ability to independently ascertain credit quality. Congress has a knee-jerk reaction to solve every problem in corporate America. Let's regulate chief executive officer compensation. Following the leveraged buyout craze of the 1980s, that was their principal solution. That's when we've had the first cap on compensation, removing its deductibility for IRS purposes. They're like a guy with the hammer. Everything looks like a nail. What we need is for shareholders in this country to wake up and demand quality from the boards of directors that are elected to oversee our companies on behalf of owners. I hate to think that our successful system in the United States of America has to have a mommy Congress that sets out rules for the private sector on how we pay management. Once again, common sense has been lost. We have chief executive officers making tens of millions of dollars, or in some cases, hundreds of millions of dollars, when they're terminated for failure. This is not for the government to correct. We need directors who are not just independent on paper, but are committed to representing the shareholders. In conclusion, one must realize and accept that panics and crashes are the opposite side of the coin of economic growth and rebirth. No amount of computer prophecy or academic sophistication will dampen the hurricane of an overheated bubble market. There is the inevitable reversion to the mean. The time for reform is now. The Congress has ignored much of what is locking up markets today, or worse, and sadly, has been the architect of it. Pogo finally was right. The root cause of future panics will be simply taking on too much risk without properly assessing the return. We live in the greatest country in the world with the finest economic system, and those of us who represent shareholders as corporate directors and management must nurture and protect it for the essential system that it is. And let's demand the same of our elected officials. And before I turn to your questions, Skip asked me to do a quick, and I do mean quick, take a look at Arkansas as a snapshot of how are we doing in the face of this national storm. If you read today's paper, I don't think it was your article, David, but there was an interesting article about unemployment rates in Arkansas and how they look, amazingly good. And are the numbers reliable or not? But regardless of 0.1% here or not, compared to the U.S. 6.1% unemployment rate, Arkansas's current unemployment rate of under 5% is healthy. Our economy continues to be diverse here and, in relative terms, stronger than the national economy. We hope it stays that way, right? Traditionally, we've lagged, and so we've all have our fingers crossed. Mike Huckabee and Mike Beebe have done a terrific job over the last few years in stewarding the state budgets, and they are to be congratulated. And therefore, we entered this phase with a $300 million surplus. I think Mike left, Governor Huckabee left a little over $1 billion, but we did a little food rebate, and so it's decreased, but we have it. And stewardship has mattered in the state of Arkansas. But we have 29 states calling for a significant budget shortfall around the country for fiscal '09. Bank capital. Our banks in Arkansas, as of June 30th, which is the latest published data that has the comparison, 9% of bank capital versus the U.S. at 7.5. So our banks in the state have significantly more capital than national banks around the country. Bank returns. Our banks earn more money here in Arkansas, a little bit, 1% return on assets, which is traditionally a decent benchmark of bank performance, compared to a 0.5% nationwide, so about double. And then this one I think is very informing. The percentage of unprofitable institutions in the state, only 5% of banks operating in the state are operating at a loss for whatever reason. They might be a startup bank or they might have issues, versus almost 16% nationwide. So significant better job there. Now in the housing sector, I get a lot of questions, was Arkansas hit as badly in the so-called subprime crisis as I read about in Nevada or Florida or someplace like that? Here you see subprime home loans 90 days past due or in foreclosure, again June 30 data, about 11.4% in Arkansas compared to 17.9% in the U.S. So better, but you know, like my example, 11% is nothing to be proud about. You know, that's not a good number. Prime loans actually looks relatively normal to me. Prime home loans, 90-day past due or in foreclosure, June data, 2.7%. That's not a shocker. I mean, you know, that's not a historically shocking number compared to the country of 4.5, which would be on the high side. Home price change, Little Rock, North Little Rock, second quarter 08 over first quarter 08, up 0.8%, meaning home prices are relatively stable here compared to the nation down 7.6%. And then finally, existing home sales, that's a year over year, full 12 months, Arkansas down 20%, nation down 16%. So that one is a little worse than the nation, but I think that's you know, you've got to take all these things with a grain of salt, and that's 1 month's comparison to another month. Dean, I'm open for questions. Well,
let's give French a round of applause here. All right, we're going to open it for questions. We've got one at the back. Yes, sir.
French, do me a favor and carry us through TARP, what it is, what it means, midterm, short term, your thoughts on it.
Yeah. TARP is the Treasury's, essentially the core of their asset rescue plan for banks and these troubled assets. And the fundamental issue, I go back to saying they're trying to speed up the healing process, and one of those things was either buying assets from banks that are bad at some market price, and we talked about the concern with that, and Treasury is very concerned about that. What is that market price? How will they ascertain it? And secondly is to inject capital into the system. They can do that by injecting liquidity. That's when they lower rates. That injects liquidity. And they can do it by injecting capital into the banking system, and that's at the heart of TARP. They are suggesting that banks sell the U.S. Treasury preferred non-voting stock. And I can tell you that the regulators want all banks who are healthy to do that. They are really have a telephone campaign to say, please let us buy some stock in your bank, and we want you to go lend that money out, or you could buy another institution, or quite frankly, you could buy Ginnie Mae bonds with it, which is a pretty risk-adverse thing to do with taxpayer money. It would be a safe thing. It certainly would be repaid, and as a taxpayer, I do want to be repaid. But that's where it stands. Banks have until November 14th to make application to the Treasury if they want any of this preferred stock money. And then they have to pay that back over 5 years, basically. And it's at a competitive interest rate. And the whole purpose of that is to improve capital ratios around the country, give banks extra capital to lend out or to purchase a weaker institution, hopefully do something good for local economies.
All right, we get one right there beside you, Bill. No, right behind you, Bill. Bill, right back there.
French, it seems like market forces have not been able to keep it, and you kind of alluded to this, they haven't been able to help us with the too big to fail problem,
Yeah.
and as well the executive compensation problem. And this is almost more of a comment than a question, but how can we get market pressures to address those problems?
Yeah, let's, I got the executive comp piece. What was your first statement, Eric? Too big to fail. Too big to fail, yeah. Well, too big to fail, though, is a function of people trying to fit in the box that has been designed by the Congress. What I mean by that is Congress set a cap on deposits nationwide of 10%. So they've allowed Wachovia now, Citibank, Bank of America to grow up to 10% of the deposits. They've set an arbitrary ceiling of 10%. And so their attitude was, if those companies are strong and have good management, we're going to let them buy anybody they want to run up to that level. So they've had an incentive to do that. Secondly, people in Washington love neat, tidy things, and they love the fact that they can just call 25 people and have a conversation with them. They don't want to have to deal with these 8,000 community banks that are in every town and every... Governor Tucker was once a congressman. He knows of what I speak, and absolutely, they think that's tidy. I think that's dangerous. And so to me, it's a regulatory policy issue. It's not, the market hadn't been allowed to deal with it. For example, if the Carlyle Group, a big famous private equity firm, happens to be headquartered in Washington, wanted to buy a big bank, they're prohibited from owning more than 25% of the voting stock of that bank by law. We don't allow foreigners or investors to own more than 25% of a bank holding company without themselves registering as a bank holding company. And if you register as a bank holding company, then you're prohibited from owning all these other businesses. And it was part of the Depression-era reforms to separate, you've heard this, separate commerce from banking, separate commerce from banking. And that's an impediment here that prohibits market forces from working. On executive compensation, I agree with you. And most of the stock in our country is held by mutual funds and by pension funds. They by and large are the marginal investor in any company, right? You can look on any Yahoo page, pull up your favorite stock, and it will say percentage owned by institutions. And it's going to be a large number, a very large number. And management's always a very small number in relative terms. Those are the people who have to be the, quote, militant market participants to demand change at the board of directors. And that's why I say you can't legislate it, in my judgment. And you see, I mean, it's a big difference in the last 20 years. There are much more activist investors now than there were 20 years ago. But still, we see boards of directors entering into contracts with people who don't even work there a month for $100 million. I mean, this is crazy talk. And so the penalty there is you penalize that board of directors by market forces, you penalize the price of that stock by market forces, and some of that's happened. If you owned Home Depot, when one of the most egregious things happened, you saw what punishment can be like on that.
I have a question. I have the gentleman right here.
This huge injection of capital into the system, aren't we looking at a major inflationary period ahead?
If, when the government comes into the market in a big way and prints money, as I said, to try to solve all these myriad of actions, it is definitely making a future inflationary step. How it will work its way through the system remains to be seen, and we can't predict it. Example, if this is a relatively short duration, and one is able to repatriate that money back out of the system, or it gets to a very productive use quickly, you're going to dampen that. With global deflation, a recession, you don't see one of the most insidious pressures on inflation right now, which is labor inflation. In the 70s, we had commodity inflation and we had ever-present pushing by labor for raises. This is essentially a company market now in a recession, and so you don't see the wage push up on inflation. So I would tell you to watch the unemployment rate and watch the Federal Reserve actions. If unemployment flattens out and begins to improve, and they don't rapidly tighten interest rates, we will have inflation in 2 to 3 years that'll be substantial.
Any questions back over this area? There was a hand I saw earlier. Okay. Annie? Let's get the microphone.
I can talk loud enough.
I know that's right.
I know, but we need you. We need to record it for historical purposes. Do you understand?
Okay, well, I need a mic. French, I know that we had Future Little Rock and Vision Little Rock in this community. And those two initiatives were designed to give this community leadership insight on where we could be as it relates to it. And as I recall on one of the task forces that you and I served together, housing has been the triggering point in every paradigm that we've had. Do you believe that that helped some of those stats that you shared with us to have had that exercise of those two initiatives?
Do you think that, do I think that Fannie and Freddie helped? Is that the question, Annie?
No, the question is, when we had those two initiatives,
Yeah. Do I think they helped?
Because we were examining what
Yeah.
were the possibilities at least 10 years or 20 years down the road.
Right.